This past year I did 1.3 million in premiums for 24 clients, and each one of them learns the full truth about fees, loans, withdrawals, and taxes. Today we're going to cover all of it. When it comes to fees, the very first thing that anyone needs to understand who is looking into indexed universal life is that these products are very front-loaded with fees. They are not short-term vehicles. When you're looking at an illustration or a projection for the performance of indexed universal life, you'll see here on the screen in this example of a 45-year-old male putting in $1 million. In the first year, this person puts in $231,000. And what is the surrender value if the performance is 6.42%? $141,000. This means they put in 231. What was their internal rate of return on that? That's negative 39.1%. Now the accumulated value, 211,900, that's negative 8.5%. That means clearly, even though this money gained 6.42%, that there were fees in these early years that ate into that number. If you continue, even in the second year, he puts in another 231,000. Still, even with the accumulated value, we are not at the break-even point. It's not until at the end of year 4 in this illustration, if the policy performed as illustrated, that the break-even point is even hit. This is primarily because just like a mortgage on a home where the interest is all front-loaded, the same thing is happening with an indexed universal life policy. Let's take a look here at the annual cost summary for this policy. The first thing you'll notice is that there is a premium charge. It's heaviest in the beginning year. After that, it's going to stay at a consistent ratio. The same percentage of the amount of money you put in immediately goes towards that fee. There's a per policy expense charge that's just going to continue throughout the policy. Of course, this is negligible. And then here's the big kicker. In the first 10 years with this specific policy, there's a per 1,000 base charge. After year 10, down here, this charge is no longer going to be there. After this year, it's done, and then you have your base cost of insurance. Now, what happens when we go to the next slide of years 11 through 20 is that you see the per policy expense charge is still there, the premium charge is gone, the per 1,000 base is gone, there's no rider charges, and the base cost of insurance is the only thing that's left, and you'll notice it actually decreases after a certain amount of time. Now, if you are trying to do IUL to make quick money, to have this be a short-term vehicle, clearly as shown, it's not for you. However, if you have a longer time horizon and think there might be other advantages, you still might have just looked at this and seen all of those fees in the early years and think, how could this possibly be worth it? How could the internal rate of return possibly pan out? There's two things we need to look at. One is the actual internal rate of return in the projections, and two is if you notice here, in year 16 with this policy, there's this thing on the far right called conditional credit. This is what the insurance company is going to credit you as a bonus, and you'll notice this conditional credit here in year 16 all the way through 20 is greater than the cost of insurance, and that would continue until the end of the policy. But look just here, regardless of what you understood about any of those fees, at the internal rate of return report. This says retroactive back to day 1, if the policy is performing at the illustrated rate, in this case, it's 6.42%. Here's what the actual rate of return is that you can access that is your money. In the first year, you will notice those numbers that I mentioned, the negative 39.1 and the negative 8.5 on the contract value. But what happens as the policy moves on all the way down to year 15? This is saying retroactive back to day 1, you have earned a 4.7% rate of return, completely income tax free. But here is the thing, in year 15, that is only 5 years after the first 10 years of those front-loaded fees is over with. If we continue, all we notice is the internal rate of return on our contract value and our surrender value is continuing to get better and better, retroactive back to day 1. This is because while they're front-loaded with fees, after that, all you have is that cost of insurance. And here's the deal. If the policy is structured properly, that's a big if, it has to be structured properly, but the cash value is going to grow. The death benefit, if it was staying the same, means the cash value is consuming more of that death benefit, which means more or less you're paying for less insurance. That means as you get older, of course, the cost per $1,000 of insurance that you're paying for gets older because you're more likely to die. However, you're paying for less 1,000s worth of insurance. Therefore, as a percentage of your cash value, your fees are actually going down, hence why if the policy continues to perform at that illustrated rate of 6.42% before fees, the longer you let the policy ride out, the better the internal rate of return is going to be retroactive back to day 1. In this example, you see 30 years in, 5.66% rate of return net of all fees. that's completely tax-free, and we were illustrating at a 6.42% rate. That means this is less than a 0.8% fee, tracking back to day one, and if it performs higher than that, then even better. Here is the problem though. We just went over all those fees. Now hopefully you have the understanding of where those are coming from. Every little detail is really ironed out there for you. You understand the internal rate of return, but that number we said is tax-free. How does that work? There's a couple different ways to access the money. Now we're gonna go over loans and withdrawals. First, you are going to be able to access up to that surrender value. There's 3 different ways. The first is through withdrawals. If you have a surrender value of $100,000, you can access up to $100,000 by withdrawing that money. However, withdrawals are only tax-free up to what you contributed. So in that example where the person contributed $1 million, if they wanted to withdraw $1 million from the policy, that would be tax-free. They wanted to withdraw $1.1 million from that policy, that $100,000, that is going to be fully taxable. Now you might be wondering, then why does everyone say it's tax-free? This is through accessing the money through policy loans. The second type is a fixed loan. These aren't always available in the very early policy years, but another word for them is a zero wash loan. The reason this is because you are loaning at a certain percentage, say 2%, but the insurance company is crediting you an equal and opposite rate of 2%. So you're getting charged 2% over here, but you're gaining 2% over here, fixed interest. Therefore, it is like a zero wash. These are the safest type of tax-free policy loan. However, what I would personally do and what most people do is take what are called indexed loans. These loans are variable, meaning they change. And the idea is, let's say, for example, you were loaning money out at a 5% rate. Well, what an index loan does is it allows that same money, even though you've already loaned it out, to stay linked to the index that you selected. So if the index you selected was the S&P 500, you loan that money out at 5%, but the S&P 500 performs at, let's say, plus 10% in a given year, then you just gained 5% on that money because you loaned it 5, you gained 10, you just made a 5% positive arbitrage on that money, and that's happening completely income tax free, only if you access that money through withdrawals up to the amount that you contributed or through more tax-free policy loans. There's a lot of nuance to these, of course. If you're taking the index loans, which is what I would personally do, you do need to be keeping an eye on this, looking at them at your annual reviews, and making sure your agent is giving you some guidance there. Again, these have to be structured properly and handled with extreme care if you want them to work the way they are marketed. Next, let's get into everything regarding the tax treatment of these vehicles. First is that these policies have to be funded with post-tax dollars. That means if you have money in a 401k or an IRA, you cannot roll it over one-to-one into an index universal life. Instead, you would have to pay the taxes, pay the penalties if you're below age 59 and a half, and then it could be contributed to an index universal life. Now it's being funded with post-tax dollars, but contrary to common belief, this actually is growing tax deferred. That means just like a 401k or an IRA. So it's growing, you're not paying capital gains or you're not paying taxes each year, but when you do go to withdraw it, it's going to be taxed. However, this is referring to withdrawals. So I mentioned earlier, withdrawals are taxed first in, first out, which means you can retrieve everything that you contributed completely income tax free. Everything above that is going to be fully taxable. However, the policy loans are fully tax free, whether you contributed or not. So if you contributed $1 million, you ended up having a surrender value of $2 million, you could access that full $2 million completely income tax free, but you have to do it through policy loans. The death benefit upon your death is income tax free, but it is not estate tax free. So if you are someone who has a very high net worth, north of 26 million currently, and doesn't avoid that estate tax, then you would be subject to estate tax. This is not a concern for most Americans. And then also keep in mind that whatever the death benefit is, its first job is it pays off the loan, and then the remainder transfers income tax free. So if you have a loan balance of $500,000, a death benefit of $1 million, the first $500,000 pays off the loan, the remaining $500,000 transfers income tax free. So here's the cool part about that tax deferral status is that even though it is technically growing tax deferred, you're able to access that money tax free through the policy loans, and then the loans are paid off by the death benefit. And since life insurance is paid out income tax free, the remainder pays out, and you never actually have to realize that tax deferral status. So we're able to keep it completely tax-free. The only other really important tax consideration to keep in mind is if you ever overloan from the policy, if you are surrendering the policy, and if the policy lapses. These things should never even come close to happening if you're funding the policy as you planned and you're meeting with your agent regularly and it's structured properly. However, if, for example, you're surrendering a policy, keep in mind that withdrawal tax, so if you put in $1 million, it grows to 2, and you surrender it and just withdraw it all, you're gonna have to pay taxes on that $1 million gain. If the policy lapses, you'd been accessing all of the money through tax-free policy loans. Well, guess what? It's going to be treated as if you just withdrew all of that money, and now you're gonna have to pay taxes on all of the gains over what you contributed. Technically, there is some protection from this above a certain age if the policy's been enforced for long enough, but we'd cover that in another video. But the main thing here, the entire point of this video, is you need to understand it is a long-term vehicle. The fees are front-loaded, so you're not going to see those amazing returns in the first 10 years. You can keep all of this money completely income tax-free if you are accessing through policy loans, and you don't need to worry about any sort of income tax when you pass away, any sort of overloaning, any sort of lapsing, as long as you're holding your annual reviews with your agent and they're guiding you through that. None of these things should ever be a problem, but they are such hot topics because they are things that people do not treat with care and fail to understand before they get into a policy. That is why it is completely crucial to educate yourself fully before making a decision about Indexed Universal Life. If you'd like to start that process and really learn the ins and outs, the nuances of Indexed Universal Life before considering one for yourself, feel free to book a 20-minute quick consult below with myself. I'd be more than happy to do that.